Hi, Year 11s. We are going to start with 1.3 today. This is putting a business idea into practice, and this is going to be part 1. Now, I've going to split this up into 2 parts because this is the longest topic of theme 1, and there's a fair bit of content to get through, so I'm going to split it into 2 different sessions for the pre-recordings. So ultimately, this first video is going to cover, we're going to look at business aims and objectives, 1.3.2 business revenues, costs and profits, and then 1.3.2 as well, which was break even. And then we'll finish the rest of this content in a separate video. So we're jumping straight into the content. Okay, so business aims and objectives. So in your business aims and objectives, so there's financial and non-financial. So the 5 ones that you need to know for this course are survival, profit, sales, market share, and financial security. So just looking at each of these, so survival is in its first year of trading. A startup business may aim just to survive. What we're talking about survival here, it's literally just to keep that business afloat. So a lot of businesses will also plan on making losses. So if they're expecting losses, their actual objective is just to keep that, so make sure that they've, say, got enough startup capital or something like that to keep them going so that they can stay in operation, so that they can eventually make profit. So that's what we talk about, survival. Moving through profit as an objective. So this is where a business actually aims to make money. So it's a financial objective. They actually want to not be making a loss. So ways that businesses can obviously increase their profits will be increasing revenue into the business. So that could be charging more for their goods and services, or the other way, which a lot of businesses can do with what they've got control over, is reduce costs. So ultimately, they could be looking at changing suppliers to cut the costs of certain things in their production and so forth. Sales as an objective is when we talk about literally just how many sales they're making. So if they want to make, they might choose to charge less for their goods and services, so that they can make more sales. The idea, if they're making more sales, that's more customer relationships and more customers that they're making connections with. The idea is that they're going to come back, those customers will return to them. So that's the other objective of using sales. Keep in mind, for your financial objectives, these are really good things. When we look at BLTs and your discuss questions, these are really good conclusions for your therefores. So therefore, they're going to make more sales because of X, Y, and Z. Or, therefore, their aim is to survive because, they're making losses in other places. So think about your financial objectives when you're looking at the big picture for what is the organization and the business actually trying to achieve. When we talk about market share as an objective, this is the idea that they might be trying to maintain a particular market share. So for example, if we're talking about Tesco's in the supermarkets, they have about 30% of the market. They probably want to keep it. But as we've got new entrants to the market, so when Aldi and Lidl sort of opened their doors, they would have been chipping away at some of that market share that Tesco had and so forth. So the supermarket market is, or the superstore market, is quite competitive in what they're doing, which is why you've now started to see Tesco's brought out a whole heap of their own products to compete with your Aldis and the Lidl so that they can maintain that market share. So generally market share, you think of it as a pie graph and you think of how much, so there's only X amount of customers in a market. If you've only got 1,000 customers in a particular market, you've only got 1,000 customers. So if you are trying to increase your market share or maintain your market share, you might be looking at trying to be more competitive in people from your rival businesses. So Tesco is probably always trying to steal customers from Sainsbury's. So when we talk about security as a financial objective, we're talking about financial security. So often people start thinking of like security guards or how do you protect your money and things like that. Think of like security protocols. That's not what this is when we look at security as a financial objective. This is basically just making sure, so if your objective is to have $500,000 in your retained profits so that you've got things, if things come up in the next 12 months, you've got financial security that you can afford to keep running your business even through economic downturns and things like that. So that's what we talk about financial security as well. The examples I've got here is if an entrepreneur has opened a new business, they might have given up another regular job. So the financial security, their goal is if they're receiving a financial from their other job, That's their personal security, so that they can pay their mortgage, their bills, their rent, and so forth. But once they give that up, they need to make sure that their business, their new venture, is earning them enough money that they are able to maintain that financial security. So that's another objective. There are lots of other objectives you could use, but as far as financial objectives, this is all you need to know for your course. Now, the non-financial objectives are a little bit fluffier, and what I mean by that is they're just a bit of a softer kind of, there are other things that motivate people for businesses, but it's often a case, it's more nice to have rather than a core focus. So the 5 that we're looking at is social objectives, personal satisfaction, challenge, independence, and control. Now, 4 of those are all parts of things that we talked about reward in topic 1.1. So let's quickly have a look through here. So social enterprises are businesses trading for a social or environmental purpose. So these are the ideas of businesses that exist in order, they're organizations that try and help other organizations. So that is their purpose, that is their objective. You've got like the Thank You company, and they sell like nice soaps and things like that. And their profits, all the profits that they actually make, go towards countries where they're struggling with hygiene and things like that. So they donate a lot of money. So they're a social enterprise. They take their objective is to help others. So that's kind of the whole idea of where a social objective comes from. That's because they're not trying to get as much profit. Obviously, they want to make as much money so that they can give it to the other whoever they're helping. But ultimately, their objective is just to help others. So they're trying to make money to help others. Personal satisfaction is just this idea of when you're creating a business, something that you're passionate about, and it's going well, you're really satisfied, which also leads into challenge. So some people just like the challenge of starting up their own business, because they just don't want to do the 9 to 5. Because when you are an entrepreneur and you're starting your own business, you tend to work around the clock, but that's part of the joy, that's part of the thrill that you get from doing that sort of business. Number 4 is independence. So this is what we talked about. Some people just don't want to be their own boss. So they've got the independence. Any decisions that they make, they get to own all of their decisions, even their fails, and they generally accept when they make a bad decision. But the other good thing about your independence, especially if you're a sole trader, you also get to get all of the profits yourself. So for some people, when they're working for somebody else, even in a small business, they might work really hard, but the person who really receives all the profits at the end is the person that they're working for, and they get paid their wages. So people like the independence, and they're rewarded for it. When business is good, they're generally financially rewarded for that as well. And number 5 is control. So it's basically the idea of when you've got your own business, you have the flexibility of choosing when you take your time off, when you've got holidays, your working hours. You control who you employ, which means you control who your colleagues are and so forth. And you also get to choose what direction the company is going for. So it's quite linked to independence, but control and independence are 2 factors. They're non-financial objectives. So as long as you can unpack these ideas of when you think what motivates a business or what the business's purposes are, this sort of leads to that as well. All right, so here's a practice question for this topic. Explain one reason why aims and objectives may differ between businesses. This is a 3 marker. You can pause this video now, give yourself 3 minutes on the clock, and have a practice. Once you're done, let's keep going. 1.3.2, so this is the first part of it, which is business revenues, costs and profits. I suggest you take some notes as we're going to be talking here. We're going to be talking a bit more about the formulas and looking at some of the maths content that comes into your course. So what we're going to be looking here is revenue, fixed and variable costs, total costs, and profit and loss. So our definition for revenue. So revenue is money coming into the business through sales from goods or services. For example, a market store that has cash box or a cash tin with money from sales in it. This way, when I think of revenue, the best way that I can think of is if you think of revenue as all of the money from any of your business operation, it's any of the money that your business is collecting. That is the best way to think of revenue. So it's any of your sales, anything depending on what your business does. So if you are selling a service, anything that you get paid for your services, if you're selling products, anything that you get paid for your products. Regardless of any of your expenses, it's just all the money that customers are paying you. There we go. So the revenue formula, so all you need to do is calculate revenue is the price times the quantity sold. So if you are a service business and you charge £25 per service and you sell to 10 different customers, you're going to do 10 times 25, which is £250. That's it. Revenue is just your price times the quantity. So if you're selling chairs for £10 each, sell 10 of them, your revenue is £100. It's pretty simple, but that's all you have to do to work out what your revenue is how much have you sold. You're not going to get, if you need to calculate revenue in an exam, they're generally not going to give you an extensive thing to quantify. You are just going to have to be looking at how much it'll give you how much the item is being sold for and how many people you've sold it to. So all you'll do, you'll have a calculator, so make sure you've got that there. It's just times one by the other, and that's giving you your revenue. Fixed costs. So fixed costs that do not vary with the level of output of sales. These costs have to be paid even if a business produces no products. So for example, the things that we look at for fixed costs are things like your rent, so your premises, that, you know, if you've got a factory, you still have to pay your rent for your factory. Sometimes you've got to pay, if you've got full-time employees, you've got to pay their salaries. Regardless if they do any work, they are employed, it is an expense that you have. Things like your internet, you pay for your internet costs, all of that for a business. The stationery costs, they are all things that your businesses need, that you pay each month. If you've got loans, if you've got mortgages, if you've got rent. So these are all of your fixed costs. These are the things that don't have anything to do with the actual units of production. Our variable costs are costs that do vary with the level of output or sales. So in this case, for example, a furniture business would have to pay for more wood if they make more furniture. So the variable cost is the cost of the wood here. So if you are producing cakes, you're going to need flour, eggs, sugar, you know, depending on what kind of cake. But if you don't sell any cakes, if though you've got a cake business, if you don't sell any cakes, you don't need to pay for the flour, sugar, and eggs because you're not using them. So therefore, those variable costs, you don't need to pay anything. So there's no cost for it because you're not using it. That's kind of the whole idea between fixed and variable costs. So when we think of fixed are the ones that your business has to pay regardless of what the business is doing, variable costs are the ones that relate purely to that point of production. When you get exam questions on this, they will be really clear. They'll just kind of give you what the costs are. You just need to recognize if it's a variable, is it part of what they're actually selling? And they'll tell you what type of a business it is. Or they'll just say, these are your variable costs, these are your fixed costs. So you just need to know what to do with them in a calculation. Now, our total costs. So the definition of that is the sum of all the costs in the business. They are fixed and variable costs added together. So as output, when we talk about as output, so as things are being produced or more sales are being made, the total cost will rise. And that is because we have our fixed costs, which is a flat line, and our variable costs will start increasing the more that we make. So that's the whole idea of why you will see your total costs always going up when you've got more output. Now, so the total cost formula, so this is the formula to calculate total cost, is your fixed costs plus your variable costs. So ultimately, if you're looking at your calculation, something to be aware of, so let's say it gives you your figure for your fixed costs, but your variable costs will be a much smaller figure. What you'll always need to do is times it by the amount of sales. So when you get a question, it'll say that they've made 200 sales. You just have to times your variable cost figure by the amount of sales, and that is how you get your total variable costs. And you add that to your fixed costs, and that is what you have for your total costs. So you'll see on the screen there, that is total costs equals fixed costs plus variable costs. So let's have a practice question. So Jasmine runs a small handmade chocolate business. She has provided the following information. The average selling price of a box of chocolates is £5.50. The fixed costs of running the business is $12,500. And the variable cost for each box of chocolates is £2. So the question that I have for you now is calculate the total cost of producing 5,000 boxes of chocolate. This you get 2 marks for. It's a calculate question. So pause the video here, get out your calculator and just work this out. This should take you no more than 2 minutes. You'll probably have it done in less than 1. All right, let's keep going. Now, profit. So our definition for that is profit is the main objective of business. Profit is all the revenue minus the costs of the business. Profit is the amount of money left over once all the bills have been paid. The owner can keep this or invest it back into the business. Now, the formula for profit is total revenue minus total costs, or sometimes you'll see it expressed as total sales less total costs. And that is basically, so if you think of revenue as being all the money that you've collected, then your total cost is everything that you've had to pay out for that period. And whatever you got left with, that's your profit. Now, it's the same calculation, but if you see loss, so if the costs of a business are greater than the revenue, then the business will have made a loss. This does not mean that the business will close. It doesn't mean that they're going to fail. It may actually improve this the following year. So you might increase marketing costs or cutting costs for other things. There are things that can be done. It is the same. So when we talk about what is the formula for profit, it's the formula for profit or loss, but we express it as profit. So if it's going to be a loss, it'll be a negative number. So again, so if we look at our total revenue minus total costs, if that total cost is bigger, it's going to leave us with that negative number. So revenue always comes first, might take away the costs. That's going to either give you a profit or a loss. So gross profit is the amount of profit a business makes after direct costs have been subtracted from turnover. So gross profit is your revenue minus the cost of goods sold. So when we talk about cost of goods sold, it's how much we actually had to pay for selling those goods. So things like an employee's salary, like we talked about before, was more of a fixed cost because we have to pay that regardless. But for example, if your employees are selling something like TVs and they're getting a commission for everything that they sell, then let's say they're getting £10 of commission for every item they sell. So if you know that you've sold 10 units, you're going to have to times 10 by the £10, and that's going to be the cost of goods sold will be £100. So you've got to think about, so that's your gross profit is just your revenue less the cost of what it was to sell the goods. So if it was raw materials, if it was in the cakes, how much flour and eggs and sugar you had to spend to sell however many of those cakes, that is your variable costs there. So it's the cost of what it was to sell those goods. Now, cost of goods sold may not always be the same, but the cost of goods sold is the idea that everything is involved in that production of selling that good. Net profit, so we see these two figures, and we'll look at obviously again in theme 2 in more detail with margins, but net profit is the amount of profit after all the costs have been subtracted from the turnover. So your net profit equals your gross profit less your expenses. So these are all your other expenses like your rent, like your mortgage. Most of it's probably going to be your fixed costs anyway, but this is how you'd work at your net profit. Now, the net profit is actually the same figure as our final profit. So when we talk about total revenue minus total costs, that should generally get to you the same figure. But sometimes there are different business purposes where you will look at gross profit, and some questions that you will get will be specific and ask you to calculate the gross profit. So we looked before. So gross profit was your revenue minus the cost of goods sold. So the figure that you've got left then, come on, sorry. I think my battery's going on this clicker. And your net profit is equal to your gross profit less your expenses. So that's generally the rest of your expenses. Net profit is the most accurate measure of a business's profitability because it looks at all of the sales that they've made and looks at all of their outgoings, regardless of what the expenses were for. All right, we're going to continue this practice question using the same details that we used before. So using the information from Jasmine's chocolate business, in the previous question, calculate the profit made. So we're looking at the profit made from producing and selling 5,000 boxes of chocolate. The information we got before was that the average selling price of a box of chocolates was £5.50. The fixed cost of running the business was £12,500, and the variable cost for each box of chocolates was £2. So what you're calculating now is how much profit that she's made. Pause the video. For the rest of us, let's keep going. Interest. So interest is because a business might need to borrow money and most businesses do, and it's generally from a bank, and a bank will charge a percentage to do this. So this interest is the cost of taking that loan. So what it's going to mean is that when you borrow £10,000, you're going to have to pay it back with an additional, and that's basically the fees that you paid for having that loan. Now, interest is always charged at a particular percentage, but sometimes we need to work out how much interest we actually paid on a particular, on a debt that we've borrowed. So if we look at to work out how much interest is, so this is part of what your course is, what it's looking for, is to calculate how much interest was paid on a particular loan. So when we talk about the total repayment, that's how much has been paid back in the entirety of the loan. So it's your total repayment minus the borrowed amount divided by the borrowed amount times 100. Now that times 100 is so it's going to give us that correct percentage of what that borrowing rate was. So if you've borrowed £10,000 and you've paid back 10,900 in total, you're then going to do, so what you're going to do is 10,900 minus 10,000 there. Now divide that by 10,000 and times that by 100, and it would give you the figure. So I want you to do this practice question here. So a business borrowed 15,000 and paid back a total of 15,900. Using that formula on the previous slide, calculate the rate of interest that the bank has charged. Now we're going to go through all of the answers. I've got them at the end of this video, and then I've got separate questions for the other video as well. So that's 2 marks. Pause the video here. For everybody else, let's keep going. All right, so we're just going to do break even, and then we're going to call this video to a close. So break even is when a business starts up, the owner may invest a great deal in equipment, fixtures, fittings, or machinery. At the start, there will be little or no revenue and lots of costs. So that what we're trying to say there is to start a business, you're putting in a lot of money to set up that business, but you don't have any customers yet. And it sometimes can take a little while before customers start coming through. So hopefully the business is going to start to trade and then better revenue levels can be made. The business will need to know at what point they've broken even. Now that break even basically means that they've got neither made a profit or a loss. So it's when they're basically at that zero. As soon as they've gone beyond that, they've made a profit. If they haven't quite gotten there, they're still operating at a loss. So break even may be on the whole business, or it might just be on one product. So for example, sometimes you've got a really big company and they want to develop a new product. So what they might do, they might invest some of the money that they already have into that new product, but that new product isn't going to start making money until it's taken off. So it might be calculated on a simple function, or it might be calculated for an entire business, is what we're saying here. Now, this is the formula to calculate break even. Your break even is equal to the fixed costs divided by your selling price minus your variable costs. So in these answers, we're actually looking at whole units rather than a dollar figure. So what you need to basically work out is how many units of that thing you need to sell. So examples that we've looked at in the past is like hotels, how many nights they need to sell and how many rooms they need to sell before they've broken even. So those kind of ideas. So when you are working things out in full units of how many things you need to sell in order to break even, keep in mind, the question will be more specific in an exam of what your answer needs to look like. But generally, if you're selling mobile phones, you can't really sell part of a mobile phone. So what you're going to need to do is round it up to the next full number, because you can't say sell 14.5 mobile phones to break even. You'll have to have sold 15 phones before you're going to break even. So that's the idea. So keep in mind with the rounding, but generally the questions will be specific in how you need to present that answer in that scenario. So here. Rihanna runs a mobile dog grooming business. She has provided the following information. Average amount paid per customer is £25. Fixed costs of running the business per year is $7,500. And the variable cost of materials used for each dog grooming session is £10. So calculate the number of dog grooming sessions per year that Rihanna will have to do in order to break even. So use the formula, go back and use the formula on the previous page if you didn't write it down. This is a 2-mark question. All you need to do is work out how many sessions, how many dog groomings she's going to need to do in the year before she's going to break even. Pause the video here. Everybody else, let's get going. All right, so I've got this example here when it comes from like a completed table of breaking even. So if you can see, if you've only sold 50 units, the revenue you've made is £9,000 and your fixed costs are £12,000. So if you look at the fixed costs column, they are the same all the way through, no matter how many units you sell. Now the variable costs is £6,000 in this scenario. So if you've got your total costs and variable costs, that is equal to £18,000. And if you've only made £9,000, you've made a loss of £9,000 as well when you've sold 50 units. Now, if you follow all the way through, if you go to the bottom there, when you've sold 300 units, your revenue is 54,000. Your fixed costs haven't changed, but your variable costs have also gone up because of the amount that you've done. So that's ultimately, you've also got your £48,000 in costs. So 54,000 minus 48,000, that leaves us with $6,000 profit, £6,000 in profit. But if you look at the point, at the £200 point, 36,000, and her costs are 36,000 here as well in this scenario. So this is when she's broken even. She's not made a profit, she's not made a loss. But if you have a look at that table, you can kind of see visually at what point you can see when someone does break even. Now, what you should be more familiar with is what we often see is this break-even table. So this is the break-even table of what we just saw in that previous slide. So you can see there that it's all, if it's linked up to the 200 quantity at the bottom there, and you can see there that it's lined up to the £36,000. That is the break-even point where there hasn't been a profit or a loss. We can see here, anything past that point is profit, anything below that point is the loss. You can see fixed cost stays the same at 12,000 all the way through. And you can see the cost. So your variable cost is the light blue line. It starts at 0 because if you sell nothing, you don't have any variable costs. The more you sell, the more that goes up. Now that yellow line, you can see it starts at the same place where the fixed costs, it starts at the same place as the red line. And that's because it's the fixed costs and your variable costs are added together in your total costs. So that's where you've got that yellow there. Sorry, the light blue line is total revenue, which also starts at 0, and that increases as well as you make more money. But your total costs are your fixed costs plus your variable costs. So conclusions for break even, it's the point where total costs equals total revenue. Break even is the point where the business makes neither a profit nor a loss. The break even point of the product is 200 units. The business needs to sell more than 200 products to break even and then make a profit. Now, so the other thing that we need to talk about, which comes up, is the margin of safety. So the margin of safety is the amount of sales the business can lose before they make a financial loss. In other words, what can the business afford to lose in unit sales? I would argue no one can really afford to lose sales. However, it's the point before they make the loss. So you can actually calculate this. So the margin of safety equals the actual sales. So that's your total sales minus your break-even sales. So for example, in that last example, we saw that the break-even point was 200 units. If the actual sales was 210 sales, our margin of safety is 10 because our actual sales is 210 minus the 200, that leaves us with 10. So if you need to calculate margin of safety, that is how you would work it out. But understanding that margin of safety is everything above that break-even point is ultimately margin of safety, and that's margin of safety from making a loss. So it is an important concept because often you do get, especially in Section A, there are often little questions in relation to margin of safety, and that might be in the form of a multiple choice question, it might be in the form of a short answer question, so forth. Practice question. Explain one method a business could use to reduce its break-even level of output. This is 3 marks, put 3 minutes on the clock, pause the video here, and after this, we'll go through those sample answers. Okay, so if you've done your practice questions, These answers are obviously not the be all and end all, because some answers, it depends which way you go with them, but making sure that you back them up accordingly. Obviously, the calculate questions do need to be correct, but I'll show you where you can get your marks for. So the first question here, explain one difference why aims and objectives may differ between businesses. So this is just an example, and I've done the extra point here. So we do advise, if you can expand it that fourth time, like that third time after your valid point, go for it. Otherwise, as long as you've got two really good impacts that are linked, you will still get the marks. If your ideas are not linked, you don't get the marks. So a new startup business may have a focus on survival, whereas an established business may not. That's your first point. This is because the new startup won't have a loyal customer base yet. This means that they will not have a steady inflow of cash that an established business would have. Therefore, it may be harder for a new startup to break even. So you could take it in many different answers with this, because this is one that has multiple avenues of how you could explain it. So the next question here, we had to calculate the total cost of producing 5 boxes of chocolate. So our fixed costs we knew were 12,500. Our variable cost, like I said before, you take your variable cost times how many units of sales you've made. So we know that's £2 times 5,000 units, which leaves us with £10,000. So if our total costs is equal to our fixed cost plus our variable costs, it equals 12,500 plus 10,000. So the answer is 22,500. There's no decimal places. It's just simply working out. You get the 2 marks for that. Now, if you recognise that your total costs, if you at least got the 12,500 plus the 10,000, like you'd worked at the variable cost, you may still get a mark for it. But I would assume if you're doing that, then you'll be able to get that full mark for the 22,500. Now, we continued on there. We had to calculate the profit made from producing and selling 5,000 boxes of chocolate. With 2 marks. So our revenue is £5.50 times 5,000, which equals our 27,500. And your total costs were 12,500 plus 10,000, as we saw in the previous question, which was 22,500. Therefore, our profit equals revenue minus total costs. Profit equals 27,500 minus 22,500 equals £5,000. It's quite straightforward when you look at it, but it can be overwhelming when you're not used to it. Do as many practices of these as you can so you are confident with it. The maths for this course is not like doing maths in your other subjects. There's only about 12 or 13 formulas that you need to know for the entire 2-year period. All right, so our next question was a business borrowed 15,000 and paid back a total of 15,900. Calculate the rate of interest that the bank charged. So our interest rate was equal to the total repayment minus the borrowed amount, and then divided by the borrowed amount times 100. So the interest rate works out is 15,900 minus 15,000. Divided by the 15,000 times 100, 6%. 2 marks for that. So we had to calculate the number of dog grooming sessions per year that Rihanna would have to do in order to break even. So we saw here that the break even equals your fixed costs divided by your selling price minus your variable cost per unit. So we've got our fixed costs there with 7,500. Divide that by 25 minus 10, so that's 15. And ultimately, that leaves us with 500 dog grooming sessions per year. And that's all she has to do in order to break even. And for the last question was explain one method a business could use to reduce its break-even level of output. So this was 3 marks. One example of this is using cheaper raw materials in production of the product is one method. Because it will mean that the variable costs per unit are lower, therefore, this increases the difference between the selling price and the cost of making the product. This will lower the amount needed to be sold to break even. Simple as that. Also remember, with method questions, don't be talking about customers or benefits or drawbacks. You've got to be focused on the method and what that method will do. So don't change IDs in the middle, as this is something that some students messed up in their mock exams. So in this one, an alternative that you could have also done is you could have also BLT'd the method of increasing the selling price, and that would have also been a valid answer as well. So again, you could do a number of different options here. Most BLTs you can. It's just about having one key point and explaining that in full. All right, that's the end of this session. Watch the follow-up and for the rest of this topic. We'll see you there.